Welcome back to the Daily Crypto Roundup. Bitcoin has bounced back towards $60,000, but the market does not feel comfortable yet. This is not a clean risk-on celebration. This is not everyone suddenly deciding the pain is over. This is more like crypto catching its breath after another brutal flush, while traders try to work out whether we are seeing real support or just another bounce inside a much bigger downtrend. As we record, Bitcoin is sitting around $60,169. Ethereum is around $1,582. XRP is around $1.04. BNB is around $567. Solana has had a stronger bounce and is trading around $72. The important part is that most of the market is green on the day, but that green is coming after serious damage. Bitcoin dropped as low as the $58,000 area. Leveraged longs were wiped out. ETF outflows have continued, and major tokens are still on course for a rough end to the first half of the year. Before we get into the stories, a quick reminder that nothing in this show is financial advice. We are here to break down the market, explain what is happening, and help you understand the bigger picture. And if you are trading crypto and you want to support the show, we are still giving away 20 XRP to listeners who sign up to Kraken through our link. That support genuinely helps keep the show going, but only use it if Kraken is right for you and you understand the risks of trading. Now, the first big story today is Bitcoin bouncing back towards $60,000 while global markets remain under pressure. CoinDesk's live market coverage had Bitcoin recovering from overnight lows near $58,200 and climbing back towards the $60,000 zone. That sounds positive, and in the short term, it is. The market had been leaning heavily bearish, and when Bitcoin holds an area that everyone is watching, you do often get a sharp reaction. But we need to be careful here because Bitcoin is still down heavily over the month, and the wider macro backdrop is not exactly friendly. Asian stock markets were under pressure, with South Korea's Kospi and Japan's Nikkei both hit hard. Tech stocks were shaky as well. That matters because Bitcoin is still trading like a high beta risk asset. When traders sell technology, semiconductors, and growth names, crypto usually gets dragged into the same risk-off basket. The Fed is also still hanging over this market. After the recent hawkish turn from the Federal Reserve, traders had started pricing in a stronger chance of rate hikes this year. But now, according to the CoinDesk piece, markets are starting to reassess that fear. Two-year Treasury yields have come back from recent highs, and the 10-year yield is actually below where it was before the Fed meeting. That is important because if rate hike expectations cool down, crypto could get some breathing room. Bitcoin does not need perfect conditions to bounce. It just needs the market to stop getting worse every day. And there was one bit of genuine hope in today's data. Glassnode's Bitcoin accumulation trend score reportedly showed that every wallet cohort has shifted back into accumulation for the first time this year. That means retail holders, smaller wallets, larger holders, and even the biggest whale cohorts are all showing signs of buying rather than distributing. That does not guarantee a bottom. Nothing does. But it does tell us that underneath all the panic, there are still buyers stepping in around this range. CF Benchmark's head of research, Gabe Selby, made the key point. The $50,000 to $60,000 zone has acted as an important support area before. It became a major level after the spot Bitcoin ETF launch rally, and Bitcoin has revisited it several times during major stress events. So the bulls will argue that this is exactly where long-term buyers are supposed to appear. The bears, however, will point to the liquidations, ETF outflows, and repeated rejection above higher levels. They will say that Bitcoin is not proving strength yet. It is only proving that the market is oversold. That brings us to the second major story: Binance and Europe. Binance has told users in several European countries that it will restrict services because it does not have the required MyCA license in place before the July 1st deadline. MyCA, which stands for Markets in Crypto Assets, is the European Union's major crypto regulatory framework. From July 1st, crypto firms need a license from at least one EU member state if they want to provide services across all 27 countries. Binance has reportedly halted new registrations in the bloc, and told users that assets remain safe and accessible while it winds down unlicensed activity. The company withdrew its application in Greece and now plans to seek authorization in France. This is a big deal, not because Binance is finished in Europe, but because it shows where the industry is now. The days of global exchanges just operating everywhere and sorting the rules out later are disappearing. The next phase of crypto is regulated, licensed, regional, and much more expensive to operate in. For users, the key question is access. Can they trade? Can they deposit? Can they withdraw? Can they use the same products? For Binance, the key question is whether it can get approved quickly enough to stop competitors taking market share. And for the wider crypto market, this is part of a much bigger theme. Regulation is not going away. The exchanges that survive long-term will be the ones that can operate inside the rules without losing the speed, liquidity, and product range that made people use them in the first place. The third story today is Ethereum, and this one is painful. USDT briefly overtook Ethereum by fully diluted valuation as Ethereum fell to its weakest level of 2026. Market data showed USDT's fully diluted valuation around $191.5 billion, while Ethereum was around $189.3 billion at the time of the flip. Now, Ethereum later held its number 2 spot by circulating market cap, so we need to be precise here. This was not Tether permanently replacing Ethereum across every ranking, but psychologically it matters. Ethereum is supposed to be the great smart contract settlement layer. It is supposed to be the backbone of DeFi, NFTs, tokenization, Layer 2s, stablecoins, and on-chain finance. Yet in this market, a dollar-pegged stablecoin briefly looked bigger by fully diluted value. That tells you exactly what traders want right now: safety, liquidity, and dollars. This is the strongest theme of the day. People are not necessarily leaving crypto rails completely. They are moving into stablecoins. They are parking capital. They are waiting. That is very different from a total market exit. 21 Shares made an interesting point in its mid-year update, saying stablecoins fell more than 30% in the last bear market, but this time they are hitting new highs. That is massive because it suggests stablecoins are no longer just a bull market trading tool. They have become one of crypto's strongest real-world use cases. But for Ethereum, the optics are rough. Ethereum is under pressure from weak ETF flows, market selling, internal ecosystem questions, and the broader rotation into defensive assets. The Ethereum Foundation has cut roles as part of a restructuring. New research groups are forming. Treasury firms are still buying dips, with SharpLink buying Ethereum again after an 8-month pause, and Bitmine holding a very large Ethereum treasury position. So Ethereum is not dead, not even close. But the market is clearly asking harder questions now. Why should ETH command a premium? Where does value accrue? Do Layer 2s help Ethereum or drain attention away from it? Can Ethereum still lead the next cycle? Or will stablecoins, Bitcoin, and newer trading venues capture more of the mindshare? That is the Ethereum debate right now. And the fourth story ties everything together. The first half of 2026 has been ugly for crypto, but Bitcoin can at least say it has beaten strategy. CoinDesk's Daybook pointed out that as June comes to an end, major cryptocurrencies are deep in the red. Bitcoin is down around 32% for the first half. Ethereum is down around 47%. Strategy, Michael Saylor's Bitcoin holding company, is down around 43%. The total crypto market cap has fallen by roughly 30% to around $2 trillion. That is a grim set of numbers, but it also tells us something very important. Investors are becoming much more selective. They are not just buying every Bitcoin-related story. They are not blindly chasing treasury companies, proxy plays, and narrative trades. They are asking what actually works when conditions get tough. Strategy has been one of the biggest Bitcoin stories of the last few years, but in a downturn, the capital structure matters. Debt matters. Preferred shares matter. Dividend pressure matters. Volatility does not just test the Bitcoin thesis, it tests the entire machine built around it. Bitcoin itself is simple. It goes up, it goes down, and holders know what they own. But Bitcoin proxy trades can be more complicated. They can offer upside in bull markets, but they can also add layers of risk when the market turns. Meanwhile, USDT dominance has surged. Stablecoin supply has stayed strong. Hyperliquid's HYPE token has been one of the few standout winners, helped by volatility and growing interest in trading infrastructure. That tells us the market is not dead. It is rotating. Capital is not disappearing. It is becoming more defensive, more tactical, and more demanding. So where does that leave us heading into the weekend? Bitcoin holding the $58,000 to $60,000 area is encouraging, but it is not enough on its own. Bulls need to see follow-through. They need ETF outflows to calm down. They need Ethereum to stop bleeding. They need risk assets to stabilize. And ideally, they need the Fed fear to ease a bit more. The bears still have plenty of ammunition. Major tokens are on track for another weak quarter. Liquidations show the market is fragile. Binance's Europe issue adds regulatory pressure. Ethereum losing ground to USDT by fully diluted value shows just how defensive traders have become. But there is also a more hopeful way to look at this. Stablecoin strength means people are still inside the ecosystem. Bitcoin accumulation across wallet cohorts means buyers are stepping in. The $50,000 to $60,000 zone has history. And when everyone is terrified, that is usually when the market starts separating the tourists from the serious long-term players. So, today's message is this. Do not get carried away by one green candle, but do not ignore the signs of accumulation either. The market is wounded, but it is not dead. Capital is hiding, not gone. And if Bitcoin can keep defending this range, July could become a very important month. And before we wrap up, we've got this week's XRP giveaway winners. Moonhead and Homeboy both get 10 XRP each, and LA Kings Ellen and Andre Lengel both get 5 XRP each. Big shout out to all 4 of you, and thank you for supporting the show. But we need more of you getting involved in the comments because this could easily be you next week. It only takes a second to comment, and it helps the show massively. And for this episode, we're adding something extra. One random comment on today's episode will win 20 XRP. So drop a comment, tell us what you think of the market, tell us what coin you're watching, or just say hello. One of you will be picked at random for 20 XRP. As always, this is our way of giving something back to the people who keep showing up for crypto news today. As always, stay calm, manage your risk, and do not let the market bully you into emotional decisions. Thanks for listening to Crypto News Today. We will see you at the top.